Hello friends, welcome to Derivatives 301 series where I explain in detail the futures contract. In Derivatives 101 series, I covered basics of derivatives products. For example, what are derivatives? What is the significance of derivatives markets? What are the different types of derivatives? And what kind of careers are available to you if you develop expertise in derivatives. In Derivatives 201 series, I explained forward contracts in detail. What are forward contracts? I took examples of some of the forward contracts, for example, wheat and other products, and then I also told you about the differences between forwards and futures. Now in Derivatives 301 series, which is focused on futures, I'll be explaining you what are futures. I will take specific examples of futures using, let's say, Nifty 50, which is an index future. I'll also take equity futures as example. I'll explain you in detail how the positions are taken in futures products, what are, for example, open interest, how margins are calculated and paid, and different theories of pricing of futures products. For example, the cost of carry theory, normal backwardation theory, and integrated theory. I'll also help you work out the profit and loss if you are entering into a futures contract. As you know, fundamentally there are four categories of derivative products. Number 1, forwards. Number 2, futures. Number 3, options. And number 4, swaps. We are going to talk about futures in detail now. A futures contract is an agreement between two parties to buy and sell a certain product at a future date, and that agreement is executed through a recognized stock exchange. So fundamentally, futures are same as forward contracts, but they are standardized, quoted on the exchanges, and they are traded through the exchange and not directly between the two parties. Futures also have underlying assets of various types, just like forward contracts have underlying assets. In case of futures, since they are traded through the exchange, the clearing house takes the responsibility of clearing and settling the trades. Therefore, there is no counterparty risk involved in case of futures transaction. When the futures contract is traded on the exchange, one of the parties takes a long position. That party is the buyer of the contract. The other party takes the short position. So that party is the seller of the futures contract. The underlying products in case of futures are either commodities, stocks, bonds, or even indices or currencies. Since the future prices are linked to the prices of the underlying assets such as commodities and currencies, the future prices also fluctuate based on the prices of the underlying assets. Futures have been widely used on the markets across the world for approximately 200 plus years. There are some key differences between forwards and futures contracts which I have explained in a separate video. But just in a nutshell, futures are basically exchange traded, whereas forwards are OTC or custom contracts between two counterparties. Futures are listed, traded as well as cleared on the exchanges, so there is no counterparty risk, whereas forwards are directly entered into between two parties and hence there is a counterparty risk involved in those contracts. Most of the forward contracts are in the nature of genuine hedging contracts to protect the risk of buyer and seller, whereas lot of futures contracts traded on the exchanges are in the nature of speculation as well as arbitrage. The ticket size in case of forward contracts is typically high because there are businesses, corporates and industries behind those contracts, whereas in case of futures contract, the ticket sizes could even be smaller because small investors could also be trading in the futures contracts. Key underlying assets in case of forward contracts are typically commodities, currencies and fixed income securities, whereas in case of the futures contracts they are typically more of indices and equities. There are various examples of futures contract. There are index futures like Nifty 50 on National Stock Exchange or Nifty Bank or Nifty Select Mid Cap, which are the futures contracts. Also on NSE we have WTI crude oil as well as natural gas futures, which have been introduced recently in the month of May 2023. On National Stock Exchange we also have equity futures in liquid stocks like HDFC, HDFC Bank and ICICI. Also in BSE we have index futures like Sensex, and also we have equity futures in various liquid stocks. In the next videos in the Derivatives 301 series focusing on futures, I will talk in detail about essential features of futures contracts. I will give a lot of examples of futures contracts. I will help you calculate positions, open interest, margins, cost of carry, and I'll also walk you through various theories of pricing futures contracts and working out the P&L. This will help you understand future contracts in every detail. You will be able to create strategies to manage your risk or profit from futures contract, monitor your profit and loss, close out positions or exit or net out the positions, work out the gains and losses from time to time, and use futures for hedging your risk. Also, this will help you acquire skills required for developing a great career in derivative products. I hope you found this video interesting and useful. If yes, please do like this video. If you have any queries, please put them in the comment box in this video so that I can answer your queries. Thank you very much. Cheers and all the best.